Okay, real talk. Have you ever had that mini heart attack when you open your banking app on a Tuesday and you're like, wait, I definitely had $200 yesterday? It's that classic struggle where your money just seems to evaporate into thin air. We've all been there, staring at a balance that doesn't make sense, wondering if the bank made a mistake. But let's face it, they usually didn't. Most of us start our adult lives by dumping every single cent into one lone bank account. Your paycheck goes in, your Uber Eats comes out, your Netflix subscription hits, and you just hope for the best. But hoping isn't a strategy, my friend. It's the fastest way to stay broke. The problem isn't necessarily how much you're making, it's that your money doesn't have a specific home. So today, I'm going to walk you through the absolute basics of financial adulting. We're talking checking accounts versus savings accounts. No boring suits, no complex graphs, just two friends hanging out and figuring out how to stop being stressed about money. By the end of this, you're going to have a system that actually works for you, not against you. The easiest way to visualize this is the wallet versus vault metaphor. Think of your checking account as your digital wallet. It's the money you're actually using right now to buy that overpriced latte or pay your electric bill. It's designed for movement. It's the money that's meant to be spent, so it's always accessible and ready to go at a moment's notice. Your savings account, on the other hand, that's your digital vault. It's tucked away, safe and sound, back at the home base. It's not meant for your daily shopping sprees. Its whole job is to sit there, stay quiet, and grow. It's your safety net for the future, whether that's a year from now or just next month when your car decides to break down. Let's get into the nitty-gritty of the checking account. This is the control center of your entire financial life. When you get that direct deposit from work, this is where it lands. It's linked to your debit card, it's what you use for Apple Pay, and it's the account you give to your landlord for rent. It's the high traffic zone of your money world. The superpower of a checking account is liquidity. That's just a fancy finance word for I can get my cash whenever I want. You can swipe your card 50 times a day, withdraw cash from an ATM, or Venmo your roommate for last night's pizza without any penalties. There are no limits on how many times you could move money in and out.
But here's the major catch. Checking accounts pay you basically zero interest. Like, we're talking 0.01% if you're lucky. That's practically nothing. If you leave $10,000 in a checking account for a whole year, you might make enough interest to buy maybe a stick of gum. It's a terrible place to keep long-term cash because it's not working for you.
So the golden question, how much cash should actually stay in there? A good rule of thumb for us Gen Z and millennials is to keep about 1 month's worth of expenses, plus a little 20% buffer. This covers your rent, groceries, and bills, while the buffer makes sure you don't get hit with those annoying overdraft fees if a bill is slightly higher than you expected.
If you keep too much money in checking, you fall into the rich for a day trap. You see a big balance and your brain tells you, hey, we're rich. Let's buy those $200 sneakers, even if you need that money for rent in 2 weeks. Checking accounts should stay lean and mean. Keep just enough to live on and move the rest out immediately. Now let's talk about the fun part, the savings account. This is where your money starts acting like an employee instead of a guest. When you put money in here, the bank is actually paying you to keep it there. This is called interest. It's essentially free money you get just for being responsible and letting your cash chill in the vault. Pro tip: do not settle for a basic savings account at a big national bank. They usually pay peanuts. You want to look for a high-yield savings account, or HYSA. These are often at online banks, and they pay way more interest, sometimes 10 or 20 times more than a regular bank. It's the difference between earning $1 a year or $100 a year for doing the exact same thing. Savings accounts have a bit of friction, and that's actually a good thing.
In the US, there used to be a law called Regulation D that limited you to 6 withdrawals a month. While that's been relaxed lately, many banks still have their own limits. This encourages you to leave the money alone so it can actually, save. It stops you from impulse buying that random thing on Instagram. My favorite hack is niche savings buckets. Instead of one big pile of money, I divide my savings into folders. I have one called Emergency Fund, one for a dream trip to Japan, and even one for car repairs. When you name your money after a goal, it becomes way harder to spend it on something stupid because you feel like you're stealing from your future self. The emergency fund is the most important bucket of all. Aim for at least 3 months of basic living costs. Having this money tucked away in a savings account is like a giant stress relief button. When your car battery dies or you lose your job, you don't panic. You just go to the vault. It's the ultimate form of self-care.
All right, let's get tactical. Here is the game plan for the next time your paycheck hits. Most people follow the spend and pray method. They spend all month and pray there's something left to save at the end. Spoiler alert, there never is. We're going to flip that script and use a technique called paying yourself first.
As soon as that paycheck hits your checking account, you need to set up an automatic transfer. Before you buy groceries, before you pay for Netflix, move a portion, even if it's just $20, straight into your savings account. If you do it immediately, you won't even miss it. You learn to live on whatever is left in the checking account, and your savings grow automatically. Automation is your best friend because, let's be honest, our willpower is trash. If you have to manually move money every month, you'll find an excuse not to do it. But if the bank does it for you on the first of every month, it just becomes part of your life. It's like a subscription service, but the product is your own future wealth. One thing to watch out for: minimum balance requirements. Some banks are sneaky and will charge you a $12 fee every month if your account drops below a certain amount. Make sure you read the fine print. We're trying to make money here, not give it away to billionaire banks for free. If your bank has these fees, it might be time to find a new one. See, it's not about being some Wall Street math genius. It's just about moving pieces on a board. You've got your spending zone in checking and your growing zone in savings. Once you set up the bridge between them with automation, you can literally stop thinking about it and watch your balance climb while you sleep. I know what some of you are thinking. If savings pays more interest, why not just put everything in there? I get the logic, but it's risky. If you have an actual emergency, like you need cash right this second, and you've already hit your monthly withdrawal limit, you might get charged a fee, or your transfer might take 2 days. You always need that frontline cash in checking. Another huge mistake is the savings leak. This is when you keep transferring $50 from savings back to checking because you really need that extra round of drinks or a new game. If you're constantly draining the vault, it's not a savings account. It's just a checking account with extra steps. You have to respect the boundary between the two. Don't go overboard and open 10 different bank accounts on day one. It gets messy. You'll lose track of passwords, and you might miss a fee somewhere. Start simple. One solid checking account for your life, and one high-yield savings account for your future. Once you've mastered that for 6 months, then you can get fancy with more buckets. Let's talk about inflation for a second. It sounds boring, but it's why eggs cost $7 now. If your money is just sitting in a regular 0.01% savings account, it's actually losing value every year because prices are rising faster than your interest. That's why finding a high-yield account isn't just a nice to have, it's essential to keep your money from shrinking. One last warning: savings comes before investing. Don't go buying random crypto or stocks because some guy on TikTok said so, especially if you don't have an emergency fund yet. Investing is for growing wealth, but savings is for protecting your life. You need to build a solid floor before you try to build a ceiling, or the whole house will collapse. Let's do a quick recap of the master plan. Checking is for the right now. It's your digital wallet for daily life. Savings is for the later. It's your growth engine and your safety net. Pay yourself first, automate the boring stuff, and keep a small buffer in checking so you never have to pay the bank another fee again. So, here is your homework for tonight. Open your banking app and look at your savings interest rate. If you see 0.01% or 0.05%, you are literally letting the bank win. Spend 10 minutes on Google tonight looking for a high-yield savings account. There are tons of great reviews out there. Pick one and start moving your vault over there. It really doesn't matter if you're starting with $10 or $1,000. The amount is less important than the habit. The version of you 5 years from now will be so incredibly grateful that you took 5 minutes today to separate your money. You're building a foundation of freedom, one small transfer at a time. It's a marathon, not a sprint. If this made sense to you and helped clear up the confusion, do me a favor and send this to a friend who is also struggling with their bank balance. Let's all stop being broke together and start winning at this money game. If you have questions about specific banks or how to set up automation, drop them in the comments below. Seriously, go take 5 minutes right now to organize your accounts. It's the easiest win you'll get all week, and it feels so good to finally be in control. I'm rooting for you, and I'll be back in the next video with more ways to help you master your life and your money. Peace out for now, and I'll see you soon.